Market update. Apologies for the slight delay in starting the broadcast, but we're here now, and you might want to not phone a friend. You might want to phone to just take some screenshots. I'm going to share the screen with you. You can see me in the bottom corner over here waving at you. Okay, let me know where you're from as ever, but I want to dive into it because it's a nice sunny day and you've probably got better things to do on a Friday than listen to Alpesh Patel. So let's go through some of the most important things. Look, I know the markets are falling at the moment and that can feel like the end of the world. Let's also remember that which are the most held stocks by some of the biggest funds. And some of the headlines can sometimes be scary. S&P 500 to tumble 30% as recession hits later this year, says Bank of America research. One of the biggest bulls on the street thinks the market rally will broaden beyond tech in itself. The second half, that seems good. S&P 10% correction is likely. And when we look at these things, we may well think, hang on. What does that actually mean? Now, let me give you some instructive lessons. You see when these falls happen, and that's 4%. Let me just move this out of the way. You see these little falls that happen. Okay, and this is the S&P 500. You will find your risk appetite only when the market is falling. You see that fall right there of some 6% Okay, that might feel small to you. You will be throwing up as if on a roller coaster when that happens to you in life. And if that's the case, then obviously you now know what your risk appetite is. It is not even to have a fall as small as that. And this is a collection of 500 stocks. Okay, so those falls tend to be, they look small. I can take that, Alpesh, I'm big, I'm going to have 3 times leverage, blah, blah, blah. Well, no, because when the fall happens and you suddenly panic, you realize not so. And I'll come to the point of why I don't panic on those drops, not because I can see into the future, simply because if it's a baby bear, i.e. rising monthly MACD, I ignore it. If it's a mama bear, i.e. falling monthly MACD, I might sell some and take some profits. And if they're not profits because it didn't rise the way I thought it would, then so be it. And if it's a daddy bear like here, then I know to go into cash. So there's always a plan. If there's a plan, then I'm not worried. So we're going to discuss some of this stuff in this call. And I understand why people are worried. And the volatility will continue because in election years, July to November, that's what this shows. The volatility, I'm afraid, gradually increases. August is worse than September, is worse than October, is worse than November. Now, again, if we just talk more broadly about the markets themselves, you can see here since 2015, well, let's go back one more year, shall we? Let's go back 10 years. Over the last 10 years, yes, July has been one of the most successful months because it's up 94% of the time and 2.89% is the average return. But August and September are bloody awful. You get negative returns in September and you get 0 in August. Doesn't mean that'll happen. Doesn't mean the past will repeat itself, but I'm just sort of showing you what can happen. Jeff from Malaga, 2 degrees all week from, yes. Thank you very much. And Andy from Plymouth and everyone. Gummersall, beautiful Gummersall up in next to Leeds. Got loads of you on here, given that it is a Friday. Now, I'm going to share the poll. 44%. So a minority of you think the FTSE will be higher by the end of the year. Fair enough. Now, let me ask the question regarding the Dow on a down day or a down couple of days and see what people think there. Big tech stocks. Now, these are the ones which have made things move up the most, but they're also going to go through a periodic fall as they are now. And let me show you how you decide in a down market. The only time when there's some falls like this. Now, if that's an upward trend. It's not even hit the trend line. If this has made you think twice and scared the bejesus out of you, and this is Microsoft, then you've got several options. The best defense is not other stocks, it's cash. Maybe you should have held more cash. Maybe if you can't even stomach a Microsoft falling, then you've put too much money in the company. So more cash. Don't put so much in the stock. Okay, so have more stocks, basically less money in each one. And you can't get lower volatility in an individual stock than this. So maybe then indices are right for you. So if you look at this, in an upward trend, 18% drawdown, peak to trough. Do you see this? 18% is typical. Okay. If you don't like an 18% drop, then you've got no business being in the market at all. And it might be indices that are better for you, ETFs. Okay. And this is probably the safest company I can think of. Yes, I know we all love these 450% returns. Okay, we all love those 450, but you're going to have to live through some of those. That doesn't mean you have to live through every one, because you might go into cash on some of them. This looks like a baby bear. It's overbought. Don't buy things which are overbought then. If you don't like those drops, then don't buy things which are overbought MACD. Don't buy things where it's something where you can't even stomach a small drop. All right, you might say, well, I can stomach a small drop if I had $1 billion in the bank, which is why it's a lot easier for Warren Buffett to stomach those drops. But if you only want to stomach things once you've got a big amount of profit in the bank account, then start small. Just dollar cost average. Just put a tiny bit in. Once you've got some profits, add a bit more, if that's the answer. Whilst Goldman Sachs say this, there's no guarantees, of course, that this will happen again. This is 2024 year to date, and they think it's going to be like 1995. I don't live on hope, because that's called speculation and gambling. I don't like that. S&P 500 on average, the first half of July is the best period of the year. Okay. First half of the year is the best period of the year. So the second half might not be so great, is what they tend to say. Doesn't mean it's guaranteed to be the case, but that's what all this data shows. First half, and then second halves tend to be sort of weaker. You can see there, 2 halves, second half. Okay. So, on top of all of that, you've still got this story which came out last week from the Financial Times. UK pension plans overpay 1.5 billion in fees to fund managers. Well, I'd still rather have the transparency of not paying a fund manager, but knowing what I own and seeing it as I wish. The reason fund managers do so well, one of the reasons is you get the opportunity to stick your head in the sand and not see how sausages are made. And of course, our job is still going to be the same as it's always been. If the MACD falls below its moving average and we have to go into cash, we'll go into cash. That happens once in 7 years, maybe. Okay. But what I'm trying to do today is teach you how in a falling market, you get your risk appetite sorted. And once you get your risk appetite, then you can decide the level of ownership you should have. You don't decide it in an upward market. Everybody's brave. This is one of my clients, and he takes far more risk than I would take. I worry for him on days like this, but he's fine with it. And that's the point I wanted to make to you. He will even buy things that I've given him the data, but they weren't on my approved list, as it were. They didn't tick all my boxes. You know, I even said to him with Palo Alto Networks, I said, you know, momentum's good, but it doesn't hit value growth. He was fine with it. You're not that person, is the point I want to make. I'm not that person. And that's a student of mine. Okay. But he's fine with it. And this is not just his first rodeo. He's done this for many years. So anyway, like I say, with this broadcast, one of the things that I'm going to be talking about, okay, is Will still holding 2 times version Microsoft and Apple. Don't put a question mark next to it, because you're then trying to be me. I'm not going to tell you. And the reason I'm not going to tell you is because you've got to choose on your risk appetite, not I hope Alpesh is still doing that. Okay. And the only way to do that is cold turkey, is occasionally just not tell you. Because you shouldn't have to ask me. If you bought it and you know the reasons why, maybe the rising MACD, and you're only going to exit if it falls X, you'll sell Y, then you don't need to ask me. Just like I don't ask Warren Buffett, hey, mate, what are you holding? Okay. Now, here's another point. I'm not going to give you individual advice, as I always say each week in these, because I don't know you individually. So let's jump right into it. This is how the stocks look, or the sectors look. It's an update. It's going to look very similar to previous weeks. So, you know, whilst the vast majority on this side and some sectors are doing a lot better than others, like utilities, I still only want the stocks which tick all my boxes. And energy generally is doing better than many others. Some are more evenly divided. Most of the time it'll be like this. A few good ones will make up for a few poorer ones. That's just how it's going to be. Thanks, Robbie. Funny. Okay, so earnings calendar. What's coming out which might cause the market something to tumble? Well, bloody hell, CrowdStrike and Microsoft. Thank you for screwing up my flights tomorrow. What could be market movers? Possibly American Express. Well, that was before market open today anyway, and I think the market's already made up its mind which way it wants to go. I guess the biggest one are these two. Okay, over there, less so these. So keep an eye out for Tuesday. The way the market's going, it looks like it's already made up its mind that it wants to go low, but I might be wrong. It might just have a big rally up. We're not speculating on it. I don't gamble on what the earnings of Alphabet and Tesla are going to be. Okay, what I do is I look at this and I say, well, I've got a Microsoft holding. Do I want to exit? Well, I know it's overbought. If it drops X, I'll sell Y. It has dropped X. Why don't you sell? Well, my X isn't 1% or 2%. Maybe if it crosses below that upward trend and drops 15%, I might sell. I don't, I would rather always be buying Microsoft when it's down here. Okay, when the MACD is like this for this ride, so I get that ride. I don't like buying it when it's up here. I don't like it, but I might do it sometimes, like here and here and here. I don't like it. I like it when it's all the way down here, okay, because it gives me a bigger run up. But I hold it at the moment. So my issue is not, do I buy more? No, thank you. Given the market's falling, no, thank you. My issue is, when should I take any profits or get out? Do I continue waiting? Well, at the moment, I know it's falling. If you're risk averse, you might panic and get out now, which is fine. That's good if you do that. As you know, my rules are for any of these: value, growth, income. If you think I can see into the future, I can't. I cannot see into the future to tell you whether this is going to be a baby bear, a mama bear, or a daddy bear. I cannot see into that future. That future has not been foretold. Okay, we do not know. Okay, about that. The reason I therefore tick all these boxes and base my decisions on my risk appetite, as you should as well, is because the only things you can control is to make sure you don't make stupid decisions. So you make sure you pick companies which are undervalued, which are growing, which are producing dividends, cash flow, Sortino, alpha, high average returns, low downside. And even then you're not guaranteed upside. You're even then not guaranteed. And then what you do is you look at your risk appetite, you look at historic moves like this, and you say to yourself, the reward I want is that, does this stock, if it continues its upward trend over the next 12 months, will that give me the reward I want? Now, your reward might be 40% in a year, it might be 20% in a year, it might be 5% in a year. Whatever it is, will it give it to me? And will the risk in those upward moves that it's historically presented, if it did it again as soon as I've bought it, can I stomach it? Now, if you cannot, then you shouldn't have the stock. Very simple. But you can only make that determination that I've just told you about drawdown danger, depth and duration, and projection forward if you've already ticked a load of boxes here, because you're not in the business of speculating. You're in the business of making sure that you've done all the due diligence that you possibly can. That's where my data comes in. Now, the past week has been bloody for this segment of the market. Now, you see the bigger squares. The bigger squares represent market cap, market capitalization, the size of the companies. They also represent the impact it has on the S&P 500, because the S&P 500 index of these 500 companies is based upon the size of the companies. So if the S&P 500 drops, it's because the biggest blocks are red. If it rises, it's because the biggest blocks are green. Okay, so all of these put together, some of them are rising, sort of help dampen some of the falls, which is why the index hasn't in the past week fallen 5%, even though Broadcom has, because some of these, whilst they're smaller than Broadcom, actually ExxonMobil is about the same size as Broadcom, have cancelled it out. Do you see? That's why you might now decide, bloody hell, Alpesh, I never knew this, but I think I quite like indices. I see what happens with them. Good. Okay, and I might cherry pick a few stocks from it. Entirely up to you. Okay, so that's what the past week has been like. Fine, so be it. There it is. It's not all blood on the street. By the way, I am not inclined to be an optimist or a pessimist. I have no conflict of interest with you. If you stay into cash, if you go into cash, I don't lose money. If you buy the market, I don't make money. Okay, so there's no conflict of interest with you. I'm not your fund manager or your broker. I will tell you the way I see it and the way, to some extent, what I'm doing, but what I want you to do based upon your appetite, and give you options and education so you can make those decisions. Over the past year, the reason the S&P has risen is because all these boxes have risen. Okay, so that's the past year. Now, we're still looking at, if we can just try and eke out 15% per annum over 5 years, that doubles our money. 15. Okay, well, some of these in the past year have done that. 22. Nvidia's made up for 10 other companies. If you had one Nvidia and 9 companies which got 0%, you got your 15% just there. Wow. Okay. There. It's some of the big ones which will make up for some of the mediocre ones. If I could pick only Nvidia's, I would be laughing. So would Warren Buffett. Even he didn't. He doesn't own any Nvidia, just so you know. Okay? Not because he thinks it's rubbish or anything. It's just because we don't get only big companies. We get what we get. based on our process. Now, that's still the end goal. And we're still going to keep to our goal of, if you get a daddy bear, i.e. momentum falling below its own moving average from a great height like here, then we will have to hold cash. And this is why it's incredibly important to have that watching. I watch this for you every Wednesday, every Friday. I'll watch it more frequently, but don't you worry. Okay, so I just want to make that point. That's critical, because otherwise your pension loses 50%. That's why. How do you mitigate the risk? You might have more cash, you might have more indices like an S&P, and you might just make sure that you keep an eye out, that you don't ever want to be in a position where you've bought anything that's overbought and where it becomes a daddy bear. Simple. That's the simple version. Okay. And don't think buy and hold will help you either, the opposite extreme, because over 2 years you get 0%. Over 2 years we get 190, because we get that second year rise and we stay out of this. We stayed out of that because of this, and we got back in because that wasn't falling and it was on the approved list. Okay. So those two little things, look, during that period, I didn't have to do anything. Then once in 7 years, I had to do that and get back in the year after. And that gets you the 190 plus all of these gains. It's small adjustments at the right time. It's not trading in and out, in and out, in and out. Okay. That's what we're about. So otherwise you end up with a pension, which gets you down 27% in a year like blue whale. And I want to show you this again about prices before we go into the stock market again. Look at point one. It's a 59% return year for Microsoft in 2021, 59%. However, look at point two, 4 months with 0%. Look at point three, 2 months where you dropped 9% or 8%. Okay. Yet you made 59% in the year. Again, people don't often realize that that's what the price movements entail, and you can make your risk appetite accordingly. So, Alpesh, how do I know what to do when this is dropping? Well, if the prices are dropping, is it a baby bear, MACD rising, ignore it, a mama bear, MACD falling, in which case maybe take some money off the table if you really want, or if you're more risk loving, don't leave it, ignore it. Or is it a daddy bear? MACD falls below its own moving average. Simple. And if you don't like the investments that you've had, is it because the peak to trough drawdown is bigger than you're used to? In which case, don't buy those types of stocks again by just looking at the historic price movements for free on TradingView, for instance. And is it because the projection didn't work out? Okay, even if you did all of this, it's not guaranteed that you shed loads of money. But like I said, I have no opinion on any stocks. The computer has its opinions and we follow them. As the $100 billion profit producing Jim Simons famously said, I have the same approach. So again, I'm going to teach you this, really important, because at this time, it's the best time to teach you this lesson. Other times, other lessons. Then we'll go into more of the market stocks. Baby bear, 0.3, MACD rising. Mama bear, that one. Now, MACD falling. Daddy bear, go into cash. MACD from overbought, falling through its own moving average. Okay? Now, at the moment, it's a baby bear. Yeah, but it's falling. Why don't you get out? Well, because in my trading, I might get out. In my trading, this is investing. I don't trade my investments. Okay, ETFs over the past month is that. So thank you, Mr. Begging, of your webinar. What's your thoughts on NASDAQ? Will it continue to drop? Just curious. Does it really matter if you... Okay, so on this, I'll answer some of those at the end as well. Stanislav, Rodri, and Jeff, I'll answer that. You missed one webinar, whole stock market dropped 10. So look, markets year to date, NASDAQ 17% up. But this is what happens. Delight, despair, delight. You're now going through a period of despair. If you bought in July 16th, then you're going through a period of despair. Okay? Even though for the whole year it went up 17%. Because you didn't start here. But that's fine. Over the long term, it should come out in the wash. Equally, if you bought in February, March, April till June, you had 0% pretty much to show for anything. Well, 5 months of 0% returns. Alpesh, how can that be shown when it went up 17%? So how do I interpret falls, whether it's the NASDAQ or anything else? I look at the monthly. Well, I can look at the weekly. In the short term, the weekly direction of the weekly MACD, but less so. The monthly is rising. Doesn't mean this will continue rising. It just means at the moment, it's a small bear. Might turn into mama bear. Might turn today. Do I think it's going to continue falling? I have no idea whether it's going to continue falling or not. Like I said, I have no opinion. The computer has its opinions, and the computer at the moment is saying there's some downward momentum. That's a baby bear for now. Might be mama later. That's it. I'm not gambling on whether it's going to fall more. If I knew if it was going to fall more, I'd go to Ladbrokes. But for the moment, I'm standing aside because it's falling. It's raining outside. I'm carrying an umbrella, which is I'm standing aside for the moment. These are some of the sectors, as you can see, for the year so far. I don't particularly care which sectors are done or not. Well, I look at individual stocks. Similarly with this, do I have any thoughts on crypto-related ETFs? Not really. There seems to be some noise around with this. Oh, God, no, I'm not gambling on VCs and presidents. Sorry, that'd be gambling. No, I don't have any opinion on that at all, I'm afraid. It'd be gambling on news. Then I might as well go to Ladbrokes and say, the VP says this might happen. Sorry, it's not what I do. So where are we so far? Well, I don't gamble on whether it's going to be value or growth or income. What I do instead, because I don't know what's going to be the winner, is I say it has to be value, it has to be growth, and it has to be income and momentum. It has to meet all those criteria because I don't know which ones are going to win. As you can see, there's a lot which haven't since January. Most of the styles haven't. The only ones which have been value, momentum, and growth, which is why we need to tick those boxes every single time. Okay, markets over the past year, 25% on the NASDAQ in half a year. 25% up. Do you realize how spoiled you are? But wait for it, Alpesh. I felt despair for the first 6 months of that because look, it was 0%. Yes. How can you have 0% for half the year and the other half get 25? That's how the markets move. Despair, delight, despair, delight, despair. It's going to be like that. It's so difficult trying to get people to understand that we're not looking into the future. It's not what I do. It's what journalists might do, but I don't. I have very much the Jim Simons approach, which is I don't have an opinion. The computer has a... Oh, where's he gone? He's gone. My hero. I don't have an opinion. The computer has an opinion. That's good enough for a bloody 100 billion for him. I think it's worth following. Okay, so I don't have an opinion where it's going to continue falling, but the computer has an opinion that it looks like we're overbought and the momentum is downwards for now. For how long, Alpesh? I don't know. Okay, could be a baby bear, could be a daddy bear. I don't know. I can speculate, but I'm not going to put money behind speculation. It'd be irresponsible for me to speculate to you. 10 FTSE 350 stocks over the past month. That's their performance, just out of interest for you. It's just out of interest. Don't go and gamble on it. Okay, that's the S&P. As I've said, week in, week out, the momentum is upwards. It's looking a bit overbought. When it had that position before, look what it did. It has these drawdowns. Can you take that drawdown? If you can't, you've got no business owning it. And that duration, it's very simple. And I'm saying the same old thing over and over again. Would you say is a safer stock in both up and downturns compared to Berkshire Hathaway? I don't know. I've not done a direct comparison on that. Stefan, if I have a long period of falling prices, the monthly MACD looks divergent. How should I handle that? You'll have to give me a specific example. I don't like hypotheticals. S&P 500. Okay, so that's where we are as it looks. Now, if you want to have a note of caution, because people are getting a bit spoiled with the returns they've had, and when people get a bit too spoiled, I like to give them cautionary notes, is, look, August and September tend not to be good months. Neither does October. So the next 3 months might not be that good. All right, so I'll give you that. But I don't want you to be gambling and trading your investments. NASDAQ's just had that, and all of a sudden, everybody's throwing up. If you're throwing up, get the hell out. It's not for you. Because when it's done that before, look, it's had these baby bears where the monthly MACD is rising, and then it recovers before a daddy bear. So we might be about to go into this. I mean, guaranteed we're going into a baby bear. Guaranteed. How do I know that? Because we already have started. Look, it's down. There you go. Ta-da. Right? Is it going to become a mama bear like this, where it's deeper and longer, and the MACD starts falling, the monthly? Possibly. I mean, this is going like this. This is going like this. You know, we're in a baby bear. Is it going to be a mama bear? I don't know. I don't know. Am I prepared for it? Yeah, because my risk appetite is such, I don't throw up at that. If you do, it means you've put too much money into it. And therefore, now you know you shouldn't have. Okay? And you can calibrate your risk for the future. That's looking okayish. For those who want to gamble and say, oh, Alpesh says the future holds this, you're in the wrong place. I don't tell you what the future holds. I tell you that as things look at the moment, I'm happy doing this. 10 there. That's over the past month. So let's have a look at these to see if we've missed anything, how they look. They're the biggest movers. So we've been doing that recently. I don't own Tesla, as you know, at the moment. It's not moved above its moving average. By the way, if you are risk averse, which most of you are, you don't know it. You don't think you are, but you are. Okay. I've got people saying, yeah, I'm a bravest soldier out there. First bullet comes and all of a sudden it's like, shit, no, I'm not. Okay, so let's assume you're all risk averse. Then only buy when the monthly MACD has crossed its own moving average. Okay, crossed over. It never did that. So this wouldn't be ready for you at the moment. Okay, EPAM, it's not a 7, 8, or 9, so it's not one for us. And whilst that's moving up, given the volatility on this, it's not going to be on one of our lists anytime soon either. Neither is this because it's overbought, even though it's a 7, 8, or 9. And it's shot up. Sorry, it's overbought, so it's not on ours. Ford, it's a 7. It's not overbought, and it's crossed above there. Could be a special situation. However, given that it spends a lot of time going sideways, and given that the broader market's falling, I think I'll give it a swerve. Okay, bit overbought, although it's a 7 and it's going upwards. So Warner Brothers, big leap up, but too speculative at the moment still because, well, the market's falling and that's still, I'd like to see more action. Paramount. These are the big movers of the past month, remember. Yeah, sort of want to see more of that, and the market's falling, so no thanks. Mohawk, got a bit of room there, but it's not a 7, 8, or 9, so no thanks. United Health is an 8, but it hasn't broken above its own moving average. And it might well do very soon and therefore become a special situation. For the risk-loving, this is a special situation. Do you want to get into it in a falling market? Up to you. You're braver than I am. But it's one worth keeping an eye on because its drawdowns aren't that sharp. It's 18%. But assume as soon as you buy it, it will drop 18%. Okay, assume that. Always assume the worst previous drawdown will happen as soon as you buy it, and you're jinxed. Always make that assumption because private investors tend to be too optimistic and they tend to be too much gamblers. Okay, so United Health is probably the closest I can think of to a special situation. Okay, there we go. Now, just sending a note to someone about something separate. I remember Citizen Financial doesn't 7, 8, or 9, although that looks lovely, but it's not. It's more risk than I'd want to take because it's not 7, 8, or 9. For those of you who are risk loving, your call. Costco, not 7, 8, or 9, and it's overbought, so you can see the danger of pullbacks. Okay, Apple, as you know, I've still got. Amazon, as you know, I've still got. I've already told about baby bears, mama bears. But, I have a different amount of capital accumulated to you. If you bought here, you're going to panic. So, Alpesh, what do you do if, like you've got Amazon, but we don't have this massive amount of gains that you've got? So you're not sweating a fall, but we are. Well, two things. You've now learned that in future, don't buy such a large position until you've accumulated enough money to be comfortable with it. That's position one. And secondly, that actually, when you bought it, if it drops X, you'll sell Y, you really do have to stick by your pinky promises. And those things do happen. You've learned that. And now you've learned that your risk appetite might not be so great as mine is. I have got that endowment here. You don't. So would I buy more today? No, there's a falling market. Why would I? I can pick it up cheaper later, probably. Amazon, same as Microsoft and Meta, pretty much covered it. There, Bank of America, I've kept saying I'm doing a stock market update. It's not one I own. But as you can see with that, okay, as you can see with no one there. As you can see with that, it's going in that direction. It's one of Warren Buffett's favorites. It's not 7, 8, or 9, so it's not quite one for me, but that does give some room to the upside. But sorry, not one for me. Netflix, not 7, 8, or 9, and it's overbought. Okay, I'm afraid sometimes there's less choice. Warren Buffett has in his bank account billions, not because he's stupid or stupidly rich, but because if I can't find something I absolutely love, I'm not going to bloody buy it. But private investors, in my experience, are absolute gamblers. That's why they find themselves so often in Vegas, because they just have this innate desire to gamble them. I've got some money burning a hole in my pocket. 8, okay, overbought. So not for me. I'll patiently wait on the sidelines. Tesla we've covered. Berkshire, pretty volatile, actually. Pretty bloody volatile. More volatile than Microsoft. Okay, so not for me. More volatile than Microsoft. Okay, and what do you have with Berkshire? Well, it's overbought, but I know it's shot up. Maybe people are buying into it as a hedge. I don't know, but it doesn't hit my criteria, so I can't do the hedge. And I'm not in the speculative business of hedging. Eli Lilly, after all these, and one of the more sort of quality 5-like companies, look, peak to trough only 18%. But if you bought here, you're now throwing up, even though it's not down 18%. You're thinking, Alpesh was right what he said when he said, assume it will always have the biggest previous historical drop as soon as you buy it. He was right. How did he know? That is the one thing I can see into the future. And that's happened. It's overbought, but it happened. Okay. I'm not saying it's going to continue lower for the moment. All I'll say to you is it's not broken the downward trend. It's still only a baby bear, but it is overbought. So I wouldn't be buying more now. If you continue holding it, you can use your exit rules based on if it drops X, sell Y. I don't care what these analysts think. Okay, so that's me. That's me as well. What else do I have to tell you? Well, let me recap, because it's bloody worth recapping some of the obvious bloody mistakes people make. They don't look at all the factors, because even after looking at these factors, you're still not guaranteed a gain. But bloody hell, if you don't look at these, you really are gambling and speculating. And 99% of private investors gamble and speculate. Alpesh, will you do an automated system that monitors? That's the advantage. That's the intention eventually. Mohan, based on your past performance, how much on average your clients have made per year for the past 30 years? Some years 0, like 2022, and some years like last year 80%, depending on the amount of risk they took. Because last year the Nasdaq went up 55%, and in 2022 it dropped, and we had to hold cash most of the year. Okay, so what you should assume, Mohan, is you're going to get 0%, because what you should assume is for the rest of forever, the markets are going to just only fall for the next 20 years, and therefore you'll be holding cash and you'll get 0%. Okay, best assumption to make. The only assumption I'd want you to make. Certainly wouldn't want you to assume that the markets are going to behave like they did in the last 7 years, even if they might, because you might come to me with over exuberance. Okay, over exuberance. My clients tend to, if the markets have a tailwind, do well. If the market do incredibly well, not because of me, but because the market tailwind. My job is to make sure they stay in cash during those periods so they don't lose money. And my job is to make sure they don't pick stupid, dumbass stocks which see them drop more than 25% on an individual stock, which if it's one of 20 holdings, means it shouldn't impact their overall portfolio by more than 1%. It's a simple thing. So you might say, well, bloody hell, Alpesh, so all you're saying is you're just riding the coattails of the markets and claiming credit for a Nasdaq which went up 55%. Yes. But what about 2022? 0%. Yeah. I'm just stopping people making stupid mistakes, which makes me look clever. If you're in a room full of people making stupid mistakes and you're the one not doing it, you look like Einstein. I do think you want to look at valuation. I think you want to look at sales, cash flow, profits, dividends as well. Why? Because if you don't tick these pieces of information, you're taking unnecessary risk because you're flying blind. I don't want to fly blind, and that's critically important as well. Okay. So like I said, these are the stupid mistakes I want people to avoid making. When it's a mama bear and the momentum is falling, if they're uncomfortable, they've put too much money in it and they're not holding enough cash, and they might, if they're risk averse, want to sell some out. But more importantly, as I have said 1 billion times, and this is what's going to preserve your wealth, if you get an overbought position from a high MACD crossing through its moving average, get the bloody hell out of there. What percentage? Minesh, anything from 10% to, in 2022, it was like 90% in dry powder. And at the moment, if somebody's only holding cash, I'd say, well, let's just wait till Wednesday and see what the market holds. So if they're only holding cash today, it'd be 100% the answer. But if they're like me and they're holding 80% in stocks, I'd also say continue holding 80%. You see, it all depends on when you started, what you hold on that. So If we get an amazing tailwind like 2020 to 2021, then 54% returns happen. Not because I could see into the future. I didn't see that. What happened was there was a tailwind. So the stocks which are undervalued, good growth, dividend yielding, high Sortino, that means high average return, low downside risk, did incredibly well. Well, why weren't all your picks like Crocs? Because I didn't even know Crocs was going to go up 208%. I don't go around looking at all these ugly shoes. They've got great sales. They're going to go. What we do is we look at those criteria: value, growth, income, cash flow, Sortino. And then if some of them catch the tailwind like flying a kite, they will soar. If they don't, they won't. How can you have a 208 Alpesh, 137, 135, 120 and only get a 54? Because some of them will do incredibly well. Some will have to get cut out at a stop loss, and most will sit in the middle. Why can't you just pick winners like Crocs? Because I'm not even Warren Buffett can do that. Now, that's something else people don't understand. They think we're in the business of telling them the big gainers because they've read so much journalism and nonsense. We're not. This is what it looks like on a scale. And if that's 0, you'll get a few big ones, which make up for the majority of little rises up, little fallers there. And you'll cut off anything which falls too much. That's it. That's it. That's not just me. That's Warren Buffett, George Soros, and Jim Simons, and everybody else. So here's another mistake private investors make. 12 months and reevaluate, or if it drops, I mean, that's the simplest rule, 25% from the high point. In actual fact, it's a lot more subtle than that. It might be 30% if the stock you've bought typically falls 30%. You don't want to get out just on normal volatility and noise. But they make that mistake. Here's another mistake they make. They put 10,000 in, and then they don't realize that after 10 years, they're going to pay 10% in fees. That's a typical fund. That is a typical fund. It's a typical mistake. Or hear this, I've got my own pension with Legal and General, shocking 20% growth in 10 years. It is shocking when you consider that even an index, you don't need my help to get any of this. You don't need to be a client of mine. Here, there it is. It's in front of your screens. Free. There, look. Bloody hell. Okay. Over 10 years, that was 114%. There you go. Just please remember the daddy bear rule and try and get out when that drops. There you go. Go away. Bye-bye. See you. That's it. There you go. Nothing else needed. Don't need anything complicated at all. And that's pretty much what Warren Buffett says. He doesn't have the MACD rule that I do on daddy bears, but that's about it. Now, I want to do a bit better than that, though. With all my knowledge and all those books I've written, that's why I do what I do, because I want to do better than just that. Okay? Is 40% realistic? Well, no. Not unless you meet all of these 9 bloody conditions, which are pretty extensive. Market tailwind, like 2021 and 2023, you can't get it on a down year. For those who foolishly think when the market's falling, Alpesh, do you have some magic stocks you can pick out, like Jack out of the beanstalk? No, I can't. In 2022, Eli Lilly actually went up when the rest of the market fell. I did not put money in Eli Lilly because I did not have the balls to put money into one company which was going up when everything else was bloody falling. High Sortino, high alpha. What does that mean? Well, if you think about it, it's what you want. High Sortino means high average returns. If the market moves up, it goes up more. Shallower falls. What's the ideal stock look like? Let me show you what the ideal, beautiful stock looks like. Okay, for those of you who are looking at the ideal, this is what the ideal bloody stock looks like. Print this out. By the way, you can do this on TradingView for free. Okay. Print this out. That's what the ideal stock looks like. Why? Multiple years, going up consistently, very shallow drawdowns, very few drawdowns, quick recoveries. And if there is a prolonged downturn like 2022, it is telegrammed ahead by a rising MACD, which falls from a great height across its moving average. That's what the ideal stock looks like. Now, if you can't stomach a drawdown of 18%, 19 or 20, you have no business being in the markets. But don't then say to me, oh, I want a 25% drawdown because I can then take more risk, which means more returns. No, more risk doesn't mean more returns. More risk means more choice, not more returns, because you can't get more returns than bloody hell that, can you? So you've been misinformed that more risk means more returns. It doesn't. It means more choice. Okay, got it? Okay, good. Now, so that was an important point I wanted to make as well on that. It's going to be not UK or not emerging. It's going to be mainly US. You'd have to be able to go into cash in a good year. Cash is the best defense. You know, other stocks are not the best defense. There's people out there going, oh, this has gone down today, so I'm going to see what's gone up and I'll buy that. That doesn't work like that. Other stocks are not the best defense. Cash is the best defense. Seems to be news to people. You know why fund managers never tell you that? Because they can't hold cash. They have to hold other stocks. If you monitor once a fortnight, so you can see if there's any daddy bears. I do it for you anyway. Good years make up for bad. Croaky, cash return on capital invested, according to Goldman Sachs, 30% per annum. If hold for 12 months, then reevaluate. If sell anything which drops 25% or more. Okay. For us, last year was an amazing year. You are never going to get a year like I had last year again. Why do I say that? Because I like to manage my own expectations. Okay. The market was up 25% on the S&P, 55% on the NASDAQ. You're never going to get that again. Who asked me? Mohan, you're never going to get it again. Okay. Just assume you're not. Right. So for us, getting these last year, you just got lucky. Maybe. But they met our criteria: value, growth, income, cash flow, Sortino alpha. And even then, look at how imperfect we are. We had Tapestry, which gave a negative return in one of the biggest bull markets in history. What the hell, Alpesh? You did this criteria, that criteria, this criteria, this criteria. They were all green, and you still managed to lose money on a company? You idiot. Yeah, but these made up for it because they tick the other boxes. It's the only way it works. It's the same for Warren Buffett. If I knew it was going to be one stock, I'd put all my money in just the one. Okay? Those are the mistakes people make. What we're trying to do over 10 years is trying to make, if we're really modest, and you start with 100K and you add a little bit in each month, is turn 100K into $1 million every 10 years. 10, 100 million. 10, 100 million. 10 years, 100K into $1 million. It doesn't go up like this. And the rewards only come at the end, sadly. It goes like this. It goes like this. That's how the bloody market moves, for those who don't realize it. That's why everybody isn't filthy rich. All this says is the best options you've got to move to more money is slightly better performance. It's not saving more, and it's not starting sooner, because those two factors don't make as much difference as tiny bit better performance. Okay. When I did it, somebody said to me, oh, you always talk about this. Well, actually, no, my figures are also out from 2004 in the UK markets. UK, which is piss poor compared to the US, since 2004, it's an average return of something like 16 to 18% per annum, whereas the FTSE All Share is about 1% per annum in that same period, just so you know. And that's UK. US is roughly double that, because the US index is double that. Not because I'm cleverer with American, but because America happened to have things like bloody Microsoft, Apple, which meant everything did better. It's actually more than double that, but don't look at the upside. Look at the worst case. Okay? So there we go. And normally I'd say 20 stocks to 40. If you're risk averse, you'll have 40 and you'll separate, put your money into less money into each. If you're more risk loving, you'll have 20. Okay. That's how you'll do it. That's how you'll do it. I've written everything I'm telling you, I've written in my books. You can get it from the books. I will share the books with you now in case any of you haven't got them already. There's Investing Unplugged. I'm sharing that right now with you anyway. Okay, that's the croaky one. It's one of my secret formulas. Cash return on capital invested. What Goldman Sachs quantum database research division found was this: that companies in the top quartile generate 30% per annum. 30% per annum cash return on capital invested. The company's generating the most cash based on the capital they invest, because capital you invest once, think of it as a machine, and cash return is the money coming out the other end. Those companies tend to go up 30% per annum as a basket. Not every year, because in the financial crisis, nobody did. It's not guaranteed to work, but I certainly want to tick that bloody box. Got it? I want to tick that box. When people say cash is king, I want to steal their research. I want to use the research from the company whose R&D division looks at ways of making its rich clients richer. Okay, that's where I get it from. This is a typical bad portfolio of somebody who messaged me. They've got stocks which are largely UK, so pretty mediocre, poor performance in those, lots of gaps, very few greens, and a load of funds which each have 50 to 100 stocks in them, so pretty piss poor performance there as well, I'm afraid. You know, that's common. Okay, look at Bruin Dolphin. That'll be the underperformance. Now, this doesn't mean you have to go to the other extreme and have 20 stocks. You might go to the other extreme and say, you know what, I'll keep a bunch of cash and I'll have, say, an S&P 500. Something diversified with low volatility, maybe a tiny bit in a Microsoft. You can still move your risk appetite accordingly, okay? I just want to show you something that we're doing and we're working on, which is all of this. These are people who've worked for me in the past, and funnily enough, they've all ended up in financial services after being my assistants. My point is, you can pick. They happen to be women. It's coincidence. Pensions lawyer. She went on to be global head of communications for Wells Fargo Bank, venture capital, and fund manager. The point is, you can teach people with degrees in English literature, okay, who have no background in finance. None of these ladies had a background in finance. We can teach them finance or anything else. Okay, their first jobs were with me. Can I hold your hand? No, I don't want to hold your hand. Well, I sort of do. What I want to do is give you two things. Give you the data, because data gives you power and transparency. And on top of the data, I want to give you the knowledge and the know-how. Okay, that's my idea for revolutionizing the market. I want to give you all of these things. But what I discovered is you only want one-to-one tutorials with me. You want a whole load of online education, but one-to-one direct tutorials with me for life. You don't want to pay any subscriptions, and you want the data. And I created that because I think one day that could be an alternative asset management company. Like an Uber is a taxi company, Airbnb is a hotel company, but they're not, because they don't own taxis or hotel rooms. Similarly, I want mine to be an asset management company which doesn't own assets. I want you to keep your assets, and I want you to have the data and the education. And I'll give you the free education here as well, right? 90% of people take my free education. I love it. You can look at all these reviews. They're wonderful. We did them in video because they were so good. But if you do want this in more depth, let me know. On webinars, as you know, I don't want to repeat the same old spiel. You get 40% off. I let 10 people in at a time, but you don't have to get the free information as well. Anyway, there's certainly no hard sell. We are going to do well no matter what. These are the two main things people wanted. Tell me your questions. I want to give you my questions. If anybody wants to join, let me know. I'm going to limit it in numbers only because I do the onboarding, I do the hand holding. In future, when obviously we go past a certain number, I don't know which yet, we will change the structure. Not for you guys, it's a one-off for you guys on that. Tonight, Harrogate v Leeds. What's your dry powder on? Oh, mate, I wish you hadn't told me that. It's going to ruin my evening now. Okay, any questions I haven't answered, let me know. Otherwise, that's really the market. That's really the market. That's really what I wanted to tell you all, what I've just discussed. Have a look at some of those. Have a look at Campaign for $1 Million as well. If you do want to be part of the program, sorry for the garish things that you can see here. Like I say, on the webinars, I get people a 40% discount on this. What I want people to have, I'm going to show you, is the data. You need the blooming data. Okay, you certainly need the data, and on top of the data, you need the know-how. The know-how is the easy bit, but without data, the know-how is bloody useless. Just pull that up on screen. And similarly, without the know-how, having just know-how, i.e. all those books, and not the data, is useless as well. So you want to do it in both ways. So micros could be good in both good and bad times then. No, I've not said that. I don't know where you got that from. In bad times, Microsoft just fell there. And I would have gone, well, I did go into cash then. If you remember in 2022, it fell 33%. I didn't. No, Ravi, it's not what I said. That in good and bad times, Microsoft's good is not what I said at all. At all. Most stocks are correlated to the downside. When the markets are bad, most stocks are bad. Okay, look at 2022. But what we do is we pick companies which have got some degree of resilience to falls. And when there's a tailwind, which in 5 years out of 7 there is, the good ones should soar and give us a war chest. And when there's a bad year, we're in cash. Cash is the best thing in bad years. So Microsoft's good in good years, and in bad years, cash is good. Okay, sorry if that wasn't clear. Just say it again. In bad years, cash is good. All right. Which Ravi is it? It's not my Ravi, is it? It can't be my Ravi. No, it's another Ravi. Ravi Sukak. I don't know your Ravi. It's another Ravi. I thought you were the Ravi that I teach. I think can't be that Ravi. He would know this. Cash is good in bad years. I hope that's clear. Okay. Any other questions? Stands like Alpesh. If let's say Microsoft falling, would you top up or wait until on the way up? No. My entry rules are Value, growth, income, cash flow, Sortino, alpha. Does it tick all those boxes? Score of 7, 8, 9, or 10, all the greens. And is the MACD rising, i.e. not falling? That's my entry rule. My exit rule is if it drops X, I'll sell Y. Those are the rules. There is no other. So your rule I haven't tested, which, well, if it drops, would you top up? And all of that. That's trading, which isn't this. I'm talking about investing. Okay? Which is something else. Cash the king of bad years makes sense. Thanks for clarifying. Yeah, no, absolutely. And what's a bad year? When the MACD is oversold and moving through its own moving average. Okay, it's loving your business side content is valuable. Thank you very much. You've mentioned TradingView. What other resources would you be happy to share? Thank you. Glenn, well, yeah, TradingView's free. I think Koifin is good, but you've got to pay. Yahoo Finance is free. Koifin, you've got to pay. So probably not that one. Yahoo Finance. But if anybody else wants to share any of the other ones, please do. Will, do you have an automated system? Oh, no, we've done that. Okay. So, guys, that's it for now. Thank you very much. I think that's been the hour. For those who've signed up, thank you. Glad you're on the journey. Like I said, my eventual ambition is to get venture capital investment into it and maybe float it on the London Stock Exchange like an Uber or whatever else. Because having been in the hedge fund industry, I think this is revolutionary because it reaches out to more people globally than the hedge fund industry can. And it gives people the empowerment to do it themselves. It's like, how can I disrupt the taxi industry? I start an Uber. How can I disrupt the hotel industry? I start Airbnb. How can I disrupt the asset management industry? I do this. That's the disruption. And I think, you know, from what I've seen and the feedback we've got, that's the job. I'll take a look at the US market this weekend. A bit more time. Thank you. I have TV and thank you next time. Thank you all very much. Yeah, I think I'm done. You can all go and enjoy the sun. People, oh, I've got some more files to share with you. Oops. Share. I'll share some more. Okay, so sharing a load more files with you. Thank you all very much, and thanks for spending your Friday with me here too as well. I think the camera's focusing more on the back screen than it is on me. Focus on me. There we go. I think. Thank you all. Have a good one.